Hi everybody, this is Lucas Sacerdote, and I'm going to be doing a presentation on EOS Energy that went on from being a sub $200 million market cap company to a 10 plus billion force to be feared, in our opinion. This presentation is, I'll try to aim to be as thorough and complete as possible. The objective is not conciseness, the objective is not for it to be perfect, the objective was for it to be done and to help anybody that sits through the whole video understanding the business case for EOS Energy as extensively as possible. Okay, EOS Energy basically was my biggest investment since late 2023 and early 2024. As a result, I visited their manufacturing capacities in Pittsburgh, not seeing it from the inside but from the outside, and I went to the RE+, basically the biggest renewable conference in the year in Las Vegas this September. Okay, EOS went from being a $200 million market cap company to close to $10 billion today, and a force to be feared. My belief that this is still very early on, that the awareness remains minimal, even in Silicon Valley, as this user is saying, which I recommend everyone following, Bert Guilfoyle, one of the best information out there on EOS. He's saying, I've been wearing EOS hats for months now, and not even one person has spotted it and said something. I live in Silicon Valley. That's how early we are. And I agree with him. Moreover, there's still no tier 1 sell side coverage, even after JP Morgan underwrote their latest $300 million capital raise. And the recent move, this latest move from July till today, I believe was not driven by EOS specific thing, because we had no news on the company, but it was a sector rotation, portfolios rebalancing and adding exposure to batteries, because every single battery company has behaved the same way for the last month and a half. Finally, I believe EOS has key catalyst coming very soon, basically backlog converting into orders, which converts into revenue and cash. So how did we come to EOS Energy? How did we find it? How our conviction developed in this space? I used to work at a hedge fund which its biggest position was Tesla. In late 2022 and early 2023, and business units started to develop in that within Tesla, the battery storage business. So in late 2022, we started to say, hey, there's a very high chance that Tesla has a multi-billion-dollar business unit inside themselves in this battery space. We were forecasting them doing over 40 gigawatt hours of battery energy storage, and that's exactly what has been happening as we speak. In the last 12 months, Tesla basically manufactured almost 40 gigawatt hours, and they've been doing multiple billions of revenues and margin and profit from this business unit. Tesla validated storage economics, and EOS was the pure play that we found and liked the best. So the agenda for today, as I said, the idea is to be as complete and thorough as possible, is to go over the global energy market, why energy storage is key, then how to choose the right battery company, going into the background and the timeline on EOS, their product, how they are going to be producing at scale, their units of economics and financials, their team, their risks, what comes next, which in my mind is people realizing that EOS is a best-in-class US battery company and the demand that they're going to have, and boots in the ground and our conclusions. So starting with the global energy market. Okay, the energy market is undergoing an unprecedented demand growth. US electricity used to be flat for almost 2 decades and maybe even more. There was no growth in US electricity demand. The thing is, that is starting to change now. New demand is projected to grow over 50% of total. And this new demand will be met by the deployment of new energy technologies, of energy technologies. Whether those technologies are gas, or oil, or wind, or batteries, or solar, everybody has to come to their own conclusions. My belief is that the new demand will be met, a bulk of it will be met by renewables. Here we have the 50% demand growth in electricity and energy. How the mix in energy technologies has been developing, and the complete dominance that we're starting to see in renewables, and how this infrastructure build out will require trillions and trillions of dollars in investments. the bulk of those trillions of dollars will be deployed in renewable energy technologies, and particularly energy storage. People need to understand there's a demand tsunami for energy, in very large part driven by the data center energy needs. Bloomberg is forecasting that data centers will require 1,500 terawatt hours of energy, an incredible growth. They're going to grow from being less than 4% of total US energy consumption to over 12% in 2030. OpenAI alone is planning on going from 230 megawatt hours of power to over 250 gigawatts of power in 2033. That is more than India's today's energy consumption, total energy consumption. OpenAI alone plans to consume more energy than India is consuming right now. This is simply bananas. This is simply unprecedented. What we're seeing, what Morgan Stanley research is finding, is that there are 57 gigawatts of power planned in the US for data centers. And we can account for some of them, but there's a shortfall of 36 gigawatts that we don't know where they were going to be coming from. The companies deploying these energy technologies to satisfy this demand will benefit from a margin expansion because basically supply and demand, and there's no enough supply for the huge demand tsunami that we're seeing. Finally, we are already seeing electric utilities saying they plan to invest $1 trillion over the next 5 years to meet this surging demand. Electric utilities will work alongside the data centers and hyperscalers to meet this energy demand. And this is going to be $1 trillion infrastructure build out. So hyperscalers have an insatiable energy demand. Let's take a quick break to see what Chamath is commenting on this.
Don't find some compelling solves, electricity rates will double in the next 5 years. Now, if you think about how then consumers will view the use of AI, and then if you think about companies like us and others trying to use the cheapest version so that we are minimally impacting the downstream cost of these things, because it will become an energy problem, this is a very complicated thing. Now, his idea, and it's a huge PR crisis, because if you want to take big tech, which is already viewed negatively, and make their perception even worse, if you start to finger point to them and say, these guys are the reason my electricity costs have doubled in the last 5 years, that is no bueno for them. And they need to find an off-ramp ASAP.
It's a bad look, because you're saying your energy's doubling, and this could take your jobs, right? Like,
yeah, it's terrible.
Whether you believe that.
If we don't find some...
So we've got everyone starting to noticing what an incredible demand growth these tech companies are going to have, and the implications they will have in the whole US economy. So moving on, how are they going to meet this incredible demand growth? Well, we think energy storage is key for it. Why? Why energy storage is key? Energy storage is key because it's the cheapest, fastest, and easiest way to add energy to the grid. This is the biggest utility in the world. They are the largest gas operators in the world, the largest nuclear operators in the world. And what they're saying is battery storage is now the cheapest form of new capacity in the US, with an order of magnitude faster deployment than gas, with more modularity and flexible siting to enable higher system utilization and large load growth. Basically, energy storage is the cheapest, fastest, and easiest energy technology out there. When you reach that, boom. I believe batteries will be the fastest growing energy technology for the next 5 to 10 years at least. What we need to start realizing is that batteries are the real capacity, and that solar power is just a cheap, infinite fuel that is only getting cheaper. These are the comments the former Department of Energy Loan Program Officer was saying. Exactly this, that batteries are the real capacity, solar is just cheap fuel. To take into consideration, these are Tesla's Master Plan 3 findings, where they show the whole space that you need to power the world with renewables. Look at that tiny green dot over there in the US. I cannot even zoom enough for you to see them very clearly. That's the whole space you need to power the whole US with renewable energy. The thing is, you need batteries, you need the actual capacity. What we saw in history in the US is solar energy dominating growing from 4% of new additions to over 66% last year. Complete domination. Why? Because cost, time to deploy, and ease of use. They were the fastest, cheapest, and easiest technology to deploy, and they completely dominated the market. The thing is, as more solar power gets added to the grid, you start to have an imbalance between energy produced and energy needed. You've got way more energy produced during the day than when it's needed, and less energy produced during the night and evening when it's more needed. So what we saw is the surge of battery energy storage starting to play a key role in new energy capacity additions, growing from non-existent in 2020 to almost a fifth of the whole US electricity generating capacity additions in the US in 2024. Solar is the fastest energy source in the US. It provides the cheapest clean fuel ever produced. But the thing is, batteries are the real capacity, and they are the ones who turn cheap solar power into dependable, on-demand energy. My belief is that every data center will use batteries. Look at Elon Musk's comments when this account starts talking about the huge cost to build data centers in the future. His answer is basically batteries. The answer to this problem is batteries. The US grid is already capable of doing 1 terawatt of power in the steady state, but the average usage is only half of that. How do you solve this problem? You add batteries. Batteries allow the time shifting of energy. You grab the energy from when you have huge amounts when you don't need it, and then you move it to when it's scarce and more expensive. These are a couple of examples of data centers saying, hey, okay, we're going to be deploying behind-the-meter natural gas coupled with battery storage. And this is just another example of Google announcing a 4 billion data center in Arkansas, and then them saying we're going to deploy a 250 megawatt battery storage system in it, probably a 1 gigawatt hour battery storage system, which is around $250 million of capex investment, which should translate around 5% of total data center capital expenditure. Why will data centers use batteries? Basically, they are the cheapest power. They charge when electricity is cheap, and they discharge when it's expensive. And keep in mind, energy is among the biggest costs in data centers. They have the fastest time to power. They are the most reliable source of energy for the data centers. Why? Because batteries kick in instantly. They have a 5 millisecond response time, unlike a diesel generator or a gas generator, where you have to warm them up or you have inertia there. They don't respond as quickly as a battery does. They're more reliable in uptime, they're modular, and they reduce transmission investment needed. Basically, if you want to put a huge data center somewhere, you might need to invest in transmission. Basically, all the cables that you see along the road, well, you might need to invest way less on that if you add battery storage to the site. Coming back, the key insight here is battery is the cheapest, fastest, and easiest energy technology to deploy. So what is a battery? Let's take a step back and say, what is a battery? A battery has basically 3 main components: an anode, a cathode, and an electrolyte. An anode is usually kind of like a metal or material, which during the discharge, this metal oxidizes, which makes electrons flow from the anode through the electrolyte to the cathode, and that's when you discharge energy. If you want to charge, this process reverses itself, and through the cathode, electrons flow through the electrolyte to the anode, and allowing a reverse engineering of the oxidation that happened in the first place. It's basically a chemical process within this battery. There are different types of batteries. You can have a lithium-ion batteries, you have a zinc-ion battery, and many others. The difference is you might choose different materials for your anode, your electrolyte, and your cathode, but the process remains fairly the same. There's no such thing as an ultimate battery. There will always be trade-offs. So when we look at electrochemical batteries, you have different types. You have a pouch cell battery, which is like an envelope filled with those materials. You can have a cylindric a battery, all types of batteries. And within that, you can have a liquid battery, a solid state battery, and different materials for the anode, the cathode, and the electrolyte. The key to take from here is that each chemistry has trade-offs. They trade cost, they trade energy density, safety, cycle life, etc. As an example, in the early days, Tesla invested heavily in nickel, and the Chinese invested heavily in lithium iron phosphate batteries. Right now, lithium iron phosphate dominates the market. But the mix changes by use case and will continue to change as material science evolves. So, what is battery energy storage? BESS. BESS is battery energy storage system. It's basically multiple batteries working together. Usually, they're deployed in containers, like these ones, and they're filled with multiple batteries. Think of it of each battery here like the battery you would see in an electric vehicle. Well, multiple of them inside this container. Then you deploy multiple containers, and this all is integrated as a system and works together. What they do is they charge energy when it's cheap and they discharge when it's expensive. Here we can see, for example, how batteries are behaving in California, where they're charging even with negative pricing, so they're getting paid to charge energy. That's because you have so much solar power during the day that the grid is not in balance between the energy supply and the energy demand, and you might need to curtail energy assets or pay someone to take on that energy. And that's what batteries are doing in California right now. They're getting paid to charge because of the huge energy excess supply that is during the day, and then they discharge at a huge premium during the evening when energy is more scarce. What we see here is the famous duck curve. It's called a duck curve because it has the shape of a duck, and what shows is how a battery behaves during the day. Basically, you see here, this is going into negative territory during the day where you have excess solar power, the batteries are charging, and then when the sun sets off and the people return to their home and turn on their lights and the dishwasher and whatever, then they start to discharge energy. As time goes forward, we'll also start to see this bump over here increase as well. This is when people are starting to raise up and to wake up and turn on their lights and make breakfast and go into the office and whatever, prior to having huge amount of solar power to satisfy that demand. As an illustrative purpose, each one of these containers of Tesla, they cost around $1 million, and in a single charge, they're able to power 140 US homes for a whole day. So one of these can power 140 US homes for a whole day in one single charge. And it costs $1 million per container. So what we need to understand is that we've been storing energy for decades now, since the very early days of humanity. Energy storage isn't new, the form is. Basically, storing energy is making sure you have enough today to meet tomorrow's needs. For the most of modern history, we did this by stockpiling physical fuels, basically having an inventory of gas, oil, or water, or reservoirs, or whatever. So when power was needed, those fuels went through a conversion step. So basically, you lighted up that oil or that gas, or you made the water run down the reservoir to finally becoming electricity. What batteries do is they are able to store energy in a ready-to-use electrical form. They undergo a chemical process inside the battery, so they charge electricity directly. The chemical process happens inside the battery, and then they're able to discharge that same electricity back to the grid when it's needed. For this, you don't need any furnace, you don't need any turbine, you don't emit any smoke. Way, way simpler. So, we're undergoing a paradigm shift. The costs of these technologies has plummeted, and few people are realizing how competitive they are right now. For example, in the UK right now, it is cheaper to build a 1 gigawatt of gas, 6.5 gigawatts of solar, and 12 gigawatt hours of batteries, and not running the gas system. That is cheaper than building and continuously running that 1 gigawatt of gas. Why? Why is that cheaper? I'm saying, hey, you're over-investing in all this. Why is this cheaper? Well, the reason is renewables, the first system, doesn't have any fuel cost. As I said, the solar is the cheap infinite fuel. So you're charging the batteries, which are the capacity, with an extremely cheap fuel, and that beats out the gas investment by a wide margin, even by building that whole gas system and not using it. It shouldn't be shocking to anyone that the United Kingdom, is among the fastest moving countries to build a strong regulatory framework to deploy long-duration energy storage at scale. Why? Because their fuel costs, the gas costs and the oil costs for the United Kingdom are very high. This will depend in the use case, in the geography, and ever. The fuel cost for the United Kingdom might be very different to geography right next to a gas reservoir or whatever. But the thing is, these technologies are the leading energy assets right now. Batteries have been around for ages and are now reaching escape velocity. Batteries are extremely dominant in electronics. Think your iPhone, your computer, whatever. They have 100% market share there. Then they started going into 2-3-wheelers, then into cars, then into light trucks, and now stationary storage. So this is the graph of how batteries evolved over time, consisting mainly of electronics until 2014, then passenger electric vehicles starting to ramp up, and as we speak, battery energy storage, which is the yellow bar, is getting more and more significant every day. How big will battery storage be? Well, I think it's going to be $1 trillion market. Basically, Tesla's Master Plan 3, which I believe is the highest fidelity source out there, they're projecting 6.5 terawatt hours of battery energy storage at an installed cost of 184 to 235 kilowatt hours. And this extra analysis from Bloomberg and RME are saying the same thing. We expect around 6.5 terawatt hours of battery storage in 2030. 2030 is right around the corner. This is an exponential growth that the people are starting to see. And let's keep in mind, this is already $1 trillion market based on the current interconnection demand. You can go into, this is public information, you can go into the interconnection queue of the United States, and there's almost a full terawatt of battery storage in the queue. These are people requesting to connect to the grid, and there are 4 terawatt hours of battery energy storage requesting to connect to the grid today. Of course, not all these systems are going to be deployed. A small percentage of them eventually do end up being completed, but still, it shows the huge demand we're undergoing. So how do you explain this exponential growth? As we said, it's the cheapest, it's the fastest, and it's the easiest way to add incremental energy to the grid. This is a graph provided by Nextera, where they clearly show how new onshore wind and new solar, coupled with battery storage, is the cheapest way and the fastest way to deploy energy now. They, which are the largest nuclear operators in the world, are saying, hey, small modular reactors are going to be ready only in 2035 plus. That's over a decade from now, and we're going to need technologies today. Those technologies will mainly be renewables. Keeping on with the same topic, how do you explain such an exponential growth? Basically, it makes so much money. Look at 2022, a battery owner earned $100 per kilowatt in that year. The thing is, as time passed, more batteries were deployed into the grid and margins compressed. But what we can see is that the bulk of the compression came from the ancillary services. Ancillary services are basically making sure that the demand and the supply of energy in the grid matches. Energy storage is the best technology for this because of their fast response times. The millisecond response time is way better to match this with energy storage than with a gas peaker plant. But those margins have compressed and will continue to compress because ancillary services are just that. They are ancillary. They provide support to the primary activities. The primary activity of energy storage is the time shifting of energy. Is moving energy from a time when it's not needed and abundant to a time that it's needed and scarce. That's the bulk of the value. And that's where we're seeing the margin compression for the energy side of the system was way less compressed, and the bulk of the value going forward will come from this energy arbitrage. So, again, batteries are the fastest energy asset to deploy. This is just hard data showing that batteries are the ones that have the fastest time to power in the US. So, to conclude this section, why are batteries key? Because they're the cheapest, they're the fastest, and they're the easiest technology to add to the grid today. Having all this framework and conviction in the energy storage space, how do we choose the right battery company? Well, in our view, EOS Energy is among the companies that will benefit the most from this battery revolution. How did we arrive at this conclusion? Well, we started by studying the lithium-ion battery market, which is extremely competitive. You can see here how companies are alternating their lead, their market share year after year, basically because this market is dominated by Chinese players. Chinese battery companies are huge state-owned enterprise companies, which their main goal is not to make a profit, is not to return shareholder value, but to grow as much as possible to provide a strategic asset to the country and to provide labor. So if they have too much profit, they'll just reinvest, add production, lower price, and hire more people and be helpful for the Chinese government. That makes it very, very hard to earn a profit in this industry. So, what else is there? Well, we can look at alternative chemistries, because lithium-ion is great for short duration needs. Think a car going from 0 to 60 in 4 seconds, that huge burst of energy from 1 second to the other. Well, lithium is great at that. But if you need some longer discharges of energy, lithium-ion is probably not the ideal chemistry for that. So, which chemistry and which company can dominate in this segment? We're going to look at it. I believe it's EOS Energy. And also, it's not only about the technology, but about the team developing that technology. We started to look around every alternative chemistry battery company out there, and we came to the conclusion that EOS Energy was the best positioned one of all of them. So, meeting EOS Energy, background and their timeline. What differentiated EOS? What mainly differentiated EOS was the first principle approach to product development and manufacturing scalability. What do I mean by that? They focused from day one on having a product that could be manufactured at cost and at scale, and that customers would want them. I was seeing a lot of companies focusing on developing the most exciting and innovating pilot and prototype out there. The thing is, you then need to take that prototype and produce it at scale. That's what is going to make a huge company, not just a cool prototype. The hard thing is taking that prototype and commercializing it. EOS Energy was talking about this non-stop from day one. They then had the Department of Energy Validation and multiple other third-party entities, highly respected, validating their technology and saying, hey, this technology works, this technology can do what they say, and this product is ready. They do have a clear path to profitability, and they have a US supply chain, which differentiated them from the current Chinese supremacy in this battery industry. And finally, they have a huge team. I have a very big confidence in to take this technology and deploy it at mass scale. Let's take a second to hear EOS Energy CEO talking about this.
When I joined the company seven years ago, we had a chemistry. We had to figure out how to build a product. So what we did, different than a lot of other battery companies, is we said we're going to focus on a product that you can build at scale, that you can build at cost, that competes and wins both for customers and for the stakeholders and shareholders of EOS. And once you get that product, then now you got to build out, and we said we want to keep this differentiated operating performance I talked about earlier. Now you got to scale the manufacturing.
Basically a product that is cost competitive from a first principles standpoint, and then it's easy to manufacture at scale. So EOS Energy, as most industrial companies and basically every company out there, they had to go through the valley of death. They became public in late 2020, even before their latest iteration product launch. Since then, they progressed through product development, product launch, and commercializing at scale. But if we look at the famously Valley of Death and EOS share price, they resemble a lot. They went public in late 2020. They were developing the product, And then when they when the market started to realize, hey, they're going to need to take this nice prototype and commercialize it, it's going to need a lot of investment. The share price plummeted. And as they started proving their commercialization capability, the share price started to recover. I believe we're right here, and there's still a lot of room for the story to develop. Let's take a second to go over EOS's timeline. Basically, they went public in late 2020. In early 2021, they signed a couple of commercial orders, which I don't think have the highest reliability out there. In July of 2021, they did an amazing capital raise. They raised $100 million with a convertible senior paid-in-kind note with Koch. In November of 2021, they signed a 300 megawatt-hour order from Pinegate, which is one of the biggest customers. In April of 2022, they did a $200 million SEPA agreement with Yorkville, allowing them to sell common shares. In May of 2022, they submitted a Part 2 for the Department of Energy Loan Program Office. In June of 2022, they raised $7.5 million through the SEPA. 2 weeks later, they increased the authorized common share issuance from 200 million to 300 million. Then in August of 2022, they raised $94 million from Atlas at a SOFR plus 8.5% interest rate through that loan. The harsh capital raising conditions are starting to emerge. Then in September 13 of 2022, they were invited into the due diligence stage for the Department of Energy Loan Program Office. In November of 2022, they shipped the final cube or block for an 80 plus megawatt hour order for Pinegate in Eastover. This is the first commercial scale deployment EOS Energy had. In June 2023, they raised $13 million at a very unfavorable conditions. In early 2023, Nathan Crocker is named CFO. In February of 2023, they get a 47 megawatt hour order with a 4 gigawatt hour letter of intent with NextEra. They didn't name the utility, they just said it was one of among the biggest utilities in the world. And then later on, after a couple more data points started to appear, you could triangulate this was NextEra. In February of 2023, EOS Energy achieved UL 9540A certification, basically a third party saying, hey, what you say the battery does, it actually does that. Then we will get into early 2023, they raised an extra $40 million at a super harsh terms. In August of 2023, the Department of Energy issued the conditional commitment for Project Amaze. So this was a $400 million loan commitment from the Department of Energy. The thing is, this was conditional, so you needed to meet certain criteria in order to get this loan. In December of 2023, they raised the last super harsh share issuance with a 47.5 net underwritten offering. That was 34 million shares plus warrants, super harsh. Early 2024, they started to get commercial traction and ramping up not only their production capacity, but their supply chain as well. So they named Tetra, which is the electrolyte, as their preferred supplier. In February 1st, they named SABIC as the supplier for their conductive composite thermoplastic, which replaces titanium, which was the highest cost item in their battery. In April of 2024, they got a new 500 megawatt hour order from Pinegate, a repeat customer. Awesome to see. You basically have a customer saying, hey, the product I bought before, I liked it and I want it again. Great to see as a shareholder. And finally, in June 24th of 2024, Servers announced a $313 million investment into EOS. This was spread into a $210 delayed draw term loan and a $105 million revolver in case EOS needed the extra cash to ramp up. The delayed draw loan basically consisted in multiple milestones. If as EOS met them, they were able to draw money from that loan. In July 2024, they launched the commercial production of their first manufacturing line. They achieved SAT, Site Acceptance Test. The day later, they got another repeat customer, so Indian Energy and the California Energy Commission already had a a couple dozen megawatt hour project of EOS, and they said, hey, we want to double down on this. We want more of your product. Again, awesome to see. In December of 2023, they closed the Department of Energy Loan Program office, so it was no longer a conditional commitment, it was already a commitment. December 18th, they got a multiple $100 million order from the US Army, which with a developer who was a repeat customer called IEP. The day later, they were able to get the first $68 million from the Department of Energy Loan Program office. In May of this year, they raised $300 million with a combination of convertible notes and common stock. This was a much nicer issuance, basically because they had demonstrated commercial traction and the market started rewarding them a bit, not yet as they should, but a little bit more than the previous issuance. In June of 2025, they purchased the order for the second manufacturing line, and in July 1st of this year, they were able to draw an extra $22 million from this Department of Energy loan program, showing that both administrations, the Trump administration and the Biden administration, supported this company. Because this is a bipartisan company. Among the key things in our investment in EOS hinged on the technology. I mean, technology was key in this company. The thing is, we are not chemical engineers, we're not electrical engineers, so we need to base our assumptions on what people that are smarter than us think. Luckily for us, the Department of Energy and multiple national research labs and third-party entities had validated extensively EOS Energy's technology. Here you get that from a first principle standpoint, zinc was among the lowest cost and fastest to implement technologies out there in the battery space. And in this study, which they don't explicitly name EOS, but I have a strong confidence that this right here is EOS, which already had the highest technology readiness level and on the highest maturity level. And with the help of the Department of Energy ecosystem support, the increased risk, the risk was much smaller than their competition. You can even see that they have a small circle within the already small circle. Awesome to see. As we previously mentioned, EOS got a Department of Energy loan. This is the same kind of loan that Tesla got in 2010 to build out their first factory. So it's very important to internalize that this is not a grant, this is not a giveaway. This is a loan which the US federal government expects to make money from. Their loss ratio on these loans is only 3.1%. Why? Because they don't take technology risk. They do an extensive due diligence on these companies, their commercial viability, and how they're going to be repaying that loan. So having the validation that the Department of Energy was willing to put $300 million of taxpayers' money into this company increasingly helped us underwrite the company. So, moving on, we're going to talk about the product, EOS's product. Everything hinges on the cost of energy. What EOS needs to get is to develop a system that allows you to store energy at a very competitive price. In 2023, already you could make the argument that EOS had a 5 cents per kilowatt hour of stored energy. This was the long-term target for the Department of Energy for long-duration stationary storage. And EOS already had that in 2023. This work was done by Zero Sum Game, a Twitter account that started covering Tesla Energy and EOS Energy, among the first ones to ever do it. Many of EOS early investors recognized the company because of him, among them me. So I'm incredibly grateful to that guy and the work he did and the work he published for everyone to see. I believe these assumptions might be overly optimistic, especially the operating expenditure one. But there was a clear path for EOS to get to 5 cents per kilowatt hour of levelized cost of storage. Levelized cost of storage basically consists on getting the capex plus the OPEX minus the residual value divided by the lifetime cycles, multiplied by the energy capacity and multiplied by the round trip efficiency. That's how you get the levelized cost of storage. Here, I believe the zero-sum game put an operating expenditure of only $17 per kilowatt for the whole lifetime cycle of the system. I believe it's around 10 to 15 per kilowatt hours per year, which you then need to multiply by 15 probably, which gives you a levelized cost of storage of around 12 cents, but a clear path to 5 cents. In all this math, you also need to take into account probably the cost of capital, and that will depend on the capital structure of the project. But the key thing to get out from here is that you need to get to 5 cents per kilowatt hour of stored energy. If you do that, I will have a strong belief that you will have a strong, a fairly significant market share in the energy industry. So in 2023, right before their latest product, they were still with the Gen 2.3 product, and it's important to see that they already had an amazing product. I mean, this battery was already able to store 500 kilowatt hours of energy. They had a response time of less than 5 milliseconds. The self-discharge, which wasn't awesome, but it was good enough, and there was a clear path of improving it. It was silent, it had no fire risk. You could operate in a wide range of temperatures. The energy density was good enough. So basically, you were starting off from a great product. And through continuous improvement, I had a strong belief they could develop a product that had a great market product fit. So, as we said previously, they always had a first principle approach on doing a scalable, cost competitive product. We already saw this video, so we might skip it. What's this mysterious cost competitive scalable product? Well, it's the C3. The C3 is this tab over here. It looks like a tab. It's basically 20 of these black sheets filled with an electrolyte, which is a zinc aqueous electrolyte. And all these tubes are then put into a container like this, 672 of these tubes in a container. What differentiated EOS is that they had a non-lithium alternative that was aqueous, so they had basically no fire risk. But the thing is, when you have an aqueous battery, most companies, what they do is they have a flow system. Why a flow system? Because if you don't make the electrolyte flow, dendrites would form within it. What are dendrites? Dendrites are basically like little arms extending on the electrolyte, which prevents the flow of electrons through the battery, basically making it useless. So you needed to solve this problem of dendrite formation. What EOS technology did was being able to stop this dendrite formation and have a static aqueous battery. This is the key differentiator in their technology. Why? Because flow batteries will not have a place in the market, in my opinion, at least not a significant one. Because they have pumps, they have maintainers, there's deployment complexity. It's harder to do it on an industrialized case. You need to do it on a project-by-project basis. There are too many moving parts. It's too hard. I mean, there are better ways to get energy. And I believe EOS offering is way better than any flow battery out there. So I'm not bullish on flow batteries. Hopefully they all make it, but I think a static battery will always be preferable. This chemistry is patented past 2030, and from our conversations with past employees and people in the ecosystem, it's very hard to copy and reverse engineering this formula, giving EOS a durable lead on non-lithium storage. So let's review a couple of the advantages of EOS over lithium-ion. First of all, they're safe. Why they're safe? There's no risk of fire, and first of all, they don't have a risk of fire, and then they don't need fire suppression systems as lithium-ion does. They don't need also like cooling system to prevent that fire as a lithium-ion does, so that it's also cheaper to operate. They are free of health hazards. They don't use toxic materials, which lithium-ion does. They do use toxic materials. They have a stable, localized supply chain that uses off-the-shelf components with no precious or conflict materials. On the other hand, lithium-ion is highly dependent on a limited supply of internationally sourced lithium and cobalt, and is highly dependent on China. EOS Energy's product is a simple 6-step manufacturing process that enables deployment of gigawatt factories in 6 to 9 months. Basically, the manufacturing process is very, very simple. It's just a tab. You have to put on the black sheets, you have to put on the electrolyte, and that's it. Ship it. Put it in a container and ship it. On the other hand, lithium-ion batteries are incredibly complex to manufacture. No US company knows how to manufacture LFP batteries. People don't yet realize that. It's a complete dominance from China. And even with the assistance of Chinese intellectual property, it still requires 2 years to deploy a gigawatt factory, and it requires clean rooms and dehumidification systems and other complex and costly investments. The energy system in the EOS is way more durable, so after 20 years there's basically no degradation compared to lithium-ion, that they stayed between a 10 and 15 lifespan, which usually ends up being between 5 and 10. And they don't have toxic materials, which is very easy to recycle, which on the other hand, lithium-ion batteries do have toxic materials and they're hard to recycle and can pose a liability for companies who bought them and then need to get rid of them. Finally, they operate within a wide range of temperatures, and they don't require any upsizing because they can do 100% of depth of discharge. On the other hand, lithium-ion batteries need to spend a lot of money in cooling systems, in HVAC systems to maintain a tight temperature range for them to operate optimally. And they need to limit to an 80% depth of discharge. This means basically that if you get a lithium-ion battery and you run it down from 100% charge to 0% charge, you're damaging that battery. And instead of lasting between 5, 10, 15 years, it's going to last 1, 2, 3, 5, whatever it is, but it's going to significantly harm the battery. So, the scalable, cost-competitive product is this tube, is this tab. It used to be this way, and the new product is this way. It has a 2.5x power energy density, and it's way simpler to manufacture and to deploy. This used to be the old system. Look how complex that looks. And this is the new system, which is basically 672 of these tabs within a container. Let's go over the product development of this product. As we mentioned previously during the timeline, in February, EOS partnered with SABIC to develop a conductive composite thermoplastic. What they did was they replaced titanium in their battery, which was by far the costliest component, with this conductive thermoplastic. What it did almost a 3x in energy density and increased round-trip efficiency from 60% to 80%, and it dropped the self-discharge by 2/3. So there were basically no trade-offs. It was cheaper, better, and more effective. Cheaper and better. In May of 2024, EOS filed a patent that it showed how a mixture of zinc chloride with zinc bromide could enhance the performance compared to only zinc bromide. What they found was that a combination between 2 times zinc chloride with 1 time zinc bromide gave the best performance out there. And it's very important to keep in mind that zinc chloride costs around 1/4 of what zinc bromide does. So it cut material costs significantly, and it also improved the supply chain resilience. All this chemistry improved the round-trip efficiency significantly. The previous product saw a round-trip efficiency drop as you go longer in time. This new product not only increased all types of round-trip efficiency, no matter which cycle length you choose, but as you go further into the cycle length of past 12 hours and into 20 hours, you're still over 90% of Coulombic efficiency, which is very similar to round-trip efficiency. There are a couple of modifications you need to make to go from one to the other. And as we spoke later, they increased the round-trip efficiency for longer duration energy storage, but they also increased it for short duration energy storage. So they're improving on both ends of the spectrum. They got in the road trip efficiency on a competitive spot for shorter duration batteries, that means 2 to 4 hours, and they further improved the round trip efficiency in longer duration space. This is from their latest earnings presentation, where they showed an 87 to 89% round trip efficiency for sub 4-hour discharge cycles. And this is our CEO, the CEO of EOS Energy, I call it our CEO, talking about a 2-hour discharge cycle. Take a look.
So explain how the battery backups work. So what we do is we allow shifting supply to meet demand. So we could do anything from a 2-hour discharge up to a 16-hour discharge. So it gives people the flexibility to ensure that they always have power when they need it. So if you think about one of these data centers, you can have fluctuations in power demand up to 50% depending on what they're doing. Our system allows you to meet those fluctuations while the rest of the grid continues to deliver without disruption. So let's...
There you get it, from a 2-hour to a 16-hour system, which I also believe he's understating, because you could go into 20 hours as well if the customer wants it. It shouldn't be understated how vertically integrated EOS Energy is and how they fully own the IP. They own their IP from the cell to the module to the software to the cube and the energy. On the other hand, there's no US company, including Tesla, that owns their IP to manufacture lithium iron phosphate batteries. Tesla sources their intellectual property from CATL, and we do believe that Tesla will eventually figure out how to produce LFP batteries. But the thing is, it's incredibly important how EOS Energy, a small company, has full control of its intellectual property from the cell to the energy system as a whole. So this product is cost competitive. This product had a clear path to profitability. Here we see and we expect around a 40% margin at scale, even with the Inflation Reduction Act credits. This shows this spread is around a 20%, and the combination of both should give around a 20% margin for an EOS Energy system. In late 2023, they covered extensively their business plan to get to profitability, where they showed that they expected to cut the cost of the C3 launch to over almost a fifth of what it initially was at scale. And these operational improvements coming from research and development, supply chain, operations, direct materials, direct labor, and manufacturing overhead. Especially these last two items are the ones who still remain to be seen. The direct material side of it, we already saw most of the advantages from it. That is the SABIC partnership, the Tetra partnership, and the ever-increasing graphite imports. But we're yet to see the benefits of operational leverage from labor and manufacturing overhead as they increase production, but this labor and manufacturing overhead remains the same. We still have a 75% improvement in labor and a 60% improvement in manufacturing overhead from where we currently are to scale. Let's keep in mind scale is probably 1 or 2 quarters away. So what does EOS Energy sell? They sell an energy system. It's very important to keep this in mind. The factory's output is the C3, it's that tab. In what shape that's delivered, it depends on the customer. Right now, most customers are taking it on a container, and containerization is just an add-on to the factory. Putting those tabs into the container is an additional step for the factory. But at the end of the day, EOS Energy delivers an energy system. That system consists of multiple thousand of these tabs all working together. You need them to work together, integrated as a whole system. And that's what Dawn OS, their software, does. Their batteries have a response time of 5 milliseconds, but you need software to operate this and to make it run as a whole integrated system. They also have a partnership with Flexgen to develop software. Okay, let's now look at how the field deployment evolved over time. EOS started deploying these not as nice looking containers filled with batteries. Then they evolved into what they call, I think, the EOS Aurora, which changed the containerization. Then they evolved into the Gen 2 system in these big containers. Important to see here how they are able to stack one on top of the other because they're non-flammable. And finally, they arrived at the new cube design, these nicer looking white containers, one next to the other. This deployment evolved over time with the new cube design, which is now a plug and play, significantly lowering installation costs. They're now able to, they have now multiple sizable projects that have gone through from track to completion in only a matter of hours. We have here a 75 cube project that was commissioned in just 7 days with a 1 hour from track to completion. And then we have here a project in Lincoln, Nebraska with 23 cubes that were deployed using this equipment. I cannot recall the name now, but it's very nice to see how easy it is to put one next to the other, one next to the other. You just grab it with that frame and you place it next to the other. One grab it next to the other. Right next to the other. This is slashing into installation cost significantly. Very important for the evolution of the company. So, coming back, what EOS sells is an energy system. The containers and the shape in which they're deployed depends on the customer. But the thing is, what they're doing is they're deploying multiple thousands of those tabs. And since day one, EOS has been talking about modularity and stackability since day one. So what is this? It basically means that you can put one tab on top of the other, one tab on top of the other, eventually arriving at a battery building. You can build a building filled with batteries, and you can do this because these tabs are non-flammable. If you wanted to do this with lithium-ion batteries, it would be incredibly risky because placing one on top of the other, it increases the risk of fire significantly. When EOS talks about a battery building, they're already mentioning a 1 gigawatt hour per acre. You can arrive at this from a first principle standpoint. You have a 1 acre and you say, hey, this building is going to be 10 meters high. The size of the battery is X. It stores around 20 liters inside it. And you put one on top of the other, you leave 50% of space between batteries if you want to. This number just comes out of the top of my head. And you arrive at a 1 gigawatt hour per acre. Basically, from a first principle standpoint, arriving at a 1 gigawatt hour per acre is very doable with EOS technology. This is around 4 times better than lithium-ion batteries. Tesla quotes a 248 megawatt hour per acre. That's a fourth of 1 gigawatt hour. In the latest earnings call transcript, the management commented that as a result of this configuration, we can achieve over 1 gigawatt hour per acre in site density, which is 3 to 4 times greater than traditional layouts. Moreover, in the latest interview that EOS CEO did, Joe Mastrangelo, he talks about a 3 gigawatt hour energy density per acre.
I wonder if you could just help everybody to understand just what is the scale of these batteries? How large are they? And what do they compare to that we might be more familiar with in our day-to-day lives?
Yeah, so think about it. It's a battery module is about the size of a computer server. You have 20 cells inside of a battery. We then can configure those batteries either in an enclosure where you would put 672 of them in an enclosure and ship out multiple enclosures to the field, or we can put them inside buildings. Like if you do a building design, you can get a footprint density of within an acre, you can get up to 3 gigawatt hours of power on an acre. So because it's non-flammable, because it's safe, because of the fact that we don't require complex cooling systems, we can fit more of them into smaller spaces. The way that the battery weighs about 50 pounds, you get a lot of, I sometimes see some of the criticism of the company of the battery doesn't look intelligent, it doesn't look high tech. And that's the point. It's very simple. And we're trying to do this at scale with ease and make it easy for people to use it, because that's what's going to happen as we move forward.
It's amazing to see the company talking about a 3 gigawatt hour per acre project. So these battery buildings, they're not a new thing. They already exist. And moreover, we already have some breadcrumbs about EOS Energy developing a data center, probably using this site configuration. So this is the Ravenna mega site. This is a data center developed by IEP, one of their customers. And they're saying that they're going to deploy almost a 2 gigawatt hour battery storage in this data center. This is going to be supplied by EOS Energy. And when we see the partners in these projects, you can see that each and every one of them, it's a powerhouse. For natural gas, they are partnering with EQT, the largest US gas producers. For global OEMs, they're using GE Vernova, they're doing Mitsubishi Electric, Eaton, Siemens, every single one of them a powerhouse. For nuclear energy, they're partnering with Westinghouse Electric Company. And for utilities, they're partnering with Buchanan's Light and First Energy. Finally, when you arrive at next generation storage and resilience, they're using EOS Energy Enterprises batteries. Very important. So these battery buildings are already a thing. Data centers right now already use batteries, and they put them inside the buildings that the data centers are. The thing is, this poses a significant risk for fire, because lithium-ion batteries can catch on fire, especially if you stack them one on top of the other inside a building. These fires are incredibly risky for a data center developer and operator. Why? Because inside a data center you have thousands and thousands of NVIDIA GPUs that each one of them costs $10,000, and if your battery system is the responsible one for catching on fire and destroying all that equipment, people are going to get fired, for sure. So EOS Energy batteries take away these risks at all. So we've been talking about the product and how great market product fit they have. So right now the question is, how do we produce it at scale? We're going to be producing at scale through the state-of-the-art manufacturing line. EOS says that each line should be able to do more than 2 gigawatt hours per line. Our estimation is that these 2 gigawatt hours are arrived using a 10-second cycle time and around a 55% utilization rate, around here. My belief is that at scale and steady state, each line should be able to do around 4 gigawatt hours, consisting on a 7 to 8 cycle time and an 80 to 9% utilization rate. So in the future, EOS Energy is going to benefit not only from deploying additional lines, but from getting more out of each line already deployed. Each line is way cheaper than a manufacturing lithium-ion line. Setting up a manufacturing facility for lithium-ion is expected to cost over $100 million per gigawatt hour. EOS Energy is expected to cost $25 million per gigawatt hours. So it's cheaper, it's easier to set up, and it's cheaper because it's easier to set up, because you don't need these clean rooms, because you don't need these dry heating rooms or whatever. It's a simple 6-step manufacturing process that uses readily available materials and that the equipment is very easy and off the shelf and does not require an expert skilled force or whatever. This is how the line used to look like in the past. Everything was a mess. You had a lot of employees putting one thing on top of the other. There was a lot of human error because one battery might look a little bit different than the other one because of human intervention. And right now, how it looks like is multiple robots doing what human labor used to do before. This achieves a 10-second cycle lifetime, 10-second cycle for each battery. So the line is what gets you at scale. every time I look at that video, I get goosebumps. If you don't, you probably should stop seeing this video now. This manufacturing line is amazing. Seeing all those robots working in unison and in sync to basically manufacture and line a battery every 10 seconds, it's what gets this company to escape velocity. And that line exists right now, and they're producing batteries right now. This manufacturing line has significant replicability advantages. Each production line is easy to set up, it does not require any special equipment, the supply chain uses all readily available materials that have their respective existing supply chains, and their manufacturing process is easier too. There's less moving parts, there are less steps, there's less special condition needed. So basically that does not require a significant skilled force. It's easier, faster, and cheaper. Not just the battery itself, but the manufacturing line, it's easier, faster, and cheaper to deploy as well. Let's look at a short video of how EOS Energy CEO Joe Mastrangelo talks about this replicability advantage.
Itself, but the manufacturing of that product.
Well, and Joe, I think you're being modest as well, because you've really removed a lot of the rare earth minerals from your process as well, which I think makes it a much more attractive product because the supply chain exists.
Yes.
Much more readily.
Yeah, and on that one there, like, you know, I always joke, like, I'm not burdened by high intelligence. So when we were designing the product, Dave, like what we actually said to people was, you can put anything you want in the battery as long as it already exists, and it's got to have its own supply chain, because no supplier in the world is going to build a special product for a startup company, and that's ultimately how we wound up here. That was our constraint we put around designing.
So I wonder.
That is just beautiful to hear. Look at those constraints they put on themselves when they were starting to, as a company. They said, hey, we're a startup company. Nobody's going to do a supply chain for us. So we need to develop the product with a readily available supply chain. So what used to be a constraint before is going to be a competitive advantage going forward. So as you scale this manufacturing capacity, you need to scale alongside other EOS stakeholders in their ecosystem. Among them, there are electrolyte suppliers. So Tetra Technologies is their electrolyte supplier. They have already invested hundreds of millions into the refining capacity of this electrolyte. And they early in 2025, they went from shipping electrolyte in these tubes to shipping them in these tanks, which I think is around a 20x increase in size. And they've invested not only in the electrolyte refining, but also in the tanker loading system to support higher volumes. They're moving from tubes to tanks, and Tetra expects $250 million in revenues for the delivery of 8 gigawatt hours of electrolyte. That means that the electrolyte will cost $30 per kilowatt hour at scale. That would result in electrolyte cost of around 12.5% of their top line, which shows how from a first principle standpoint, EOS technology is cost competitive at scale. It also shows that Tetra highly believes in EOS's ability to scale to 8 gigawatt hours plus production capacity. And they're also mentioning that in 2026, they expect to supply at least 2 gigawatt hours of electrolyte, which would result in upwards of $500 million in revenues for EOS if they manufactured at that kind of scale. When I took a trip to manufacturing capacities in Pittsburgh, I saw firsthand how these tanks were delivering the electrolyte and not anymore tubes. They're also growing alongside their felt supplier. Just a couple days ago, they received a 60,000 kilogram felt order. This is the line of the felt deliveries to EOS Energy, basically upwards to the right. I believe that EOS is buying as much felt as they can from this supplier in order to meet the ramp, because the supplier itself is ramping up the production of this felt, so they're buying as soon as they can provide them the felt and keeping it in inventory. And it's important to mention the difference between EOS and their closest competitor in terms of production capacity. A couple days ago, EOS received 60,000 kilograms of felt, compared to their closest competitor, which received only 500 kilograms, so less than 1%. EOS is 100 times bigger in production capacity than their number 2 competitor, I think. Not only from this data point, but from many others. But this is just one of them. So when you're growing, you don't only grow alongside your suppliers, but also with your customers. IAP is a developer which has successfully grown, and they deployed EOS systems first at a couple dozen megawatt hours. Then they won a multi-$100 million order for the US Army, and they're now aiming to deploy a 2 gigawatt hour data center. So they're growing with this customer, which when I did all this research, I went back to the 2023 short attack the EOS received, and this short attack basically said that IEP was referred to as a dubious counterparty. EOS' response was that they partnered with them since 2020 to co-develop 2 energy projects in Texas, where EOS provided them upfront funding that was later repaid when the project secured financing. So they not only provided this customer with batteries, but also with funding, which shows how they have been investing in long-term relationship with their customers as well. And they're probably fairly soon going to reap those benefits from this huge data center order that IEP is developing. So let's move to units of economics and financials. These are EOS historic numbers. The discharge energy has grown significantly, now upwards of 5 gigawatt hours. The opportunity pipeline grew from under 5 billion to over 17 billion right now. The order backlog went from basically non-existent to over 700 million as of today, which has stalled in the recent quarters, but I believe this should change fairly soon. Revenue has been up and down, up and down. This is because basically deciding to produce or not at a subscale. Here they were producing with a semi-automated manufacturing line. When they took all those learnings, they shut down that line, and only when they had the fully automated line, they decided to produce again, resulting in an exponential growth, which is going to continue into the future, is my belief. It's important to mention that EOS has never generated a gross profit in its history, and as a result, it didn't generate any operating income as well. But we believe this is about to change very soon. Okay, so how are we going to turn this operating income loss into a profit? Basically, by doubling and doubling production again. EOS, since Q3 of last year, has doubled the production capacity, then double it again, then double it again. And what they're saying is we're going to double again in Q3 and double again in Q4. By doing that, they're going to end up right in the middle of the guidance range of $150 million for 2025. These are the comments from Nathan Croker, our CFO, in the latest earnings call, saying we double production with the same production processes, with the same supply chain and the same headcount. Why? Because all the investment in the manufacturing line and the sub-assemblies line is already there. So the doubling and doubling again is highly doable. And you're going to do that with the same process, with the same supply chain and the same headcount. What they're going to do forward is we double again on your guidance, and that's what we're shooting for. When doing this, as we mentioned, the direct materials cost out is mostly out of the picture, but you still have a 75% labor reduction and a 60% manufacturing reduction costs going forward as you scale production. So my expectations are that EOS should be gross profit margin in Q3 of 2025. They should have a positive operating profit in Q2 or Q3 of 2026. And from today till that moment, it's going to result in at least $136 million until they reach profitability. Okay, so this is my expectations. This is a very simple back of the envelope math. I know it looks complex, but it's not. Basically, the key assumptions here is how much EOS is going to be producing, at what price are they going to sell that production, and how much it's going to cost them to produce those batteries. With my expectations that in 2030, they're going to be producing 20 gigawatts per hour. They're going to be selling those at $200 per kilowatt hour, and it's going to be costing them around $110, $120, $130, even maybe less per kilowatt hour. You get to a 1.5 billion, between 1.5 and maybe 2.5, 3 billion in net profits based on this capacity and these margins. The basic units of economics of this business are that EOS needs to spend $50 million in capital expenditure for a manufacturing line, and that each manufacturing line is capable of doing $600 million in revenue, which 90 million of those are tax credits, so almost double the capex investment in the first year, and they should be able to do around $150 million in the bottom line. That's very back of the envelope math, and everyone should arrive at their own conclusions, but that's how I see the business going forward. EOS's balance sheet is not the cleanest balance sheet out there. They have around $360 million in assets, and they have around $900 million in liabilities. Of those, over 300 million are warrant liabilities, which every investor should decide how they treat those, but they're not common liabilities in my view. From the borrowings, EOS has a little bit over $500 million of debt from the delayed draw term loan with servers, the AFG convertible notes, the 2025 convertible notes they issued, the equipment financing facility, and the DOE loan facility, which they have $200 million yet to draw. So from the liquidity standpoint, EOS has $120 million in cash. They should be receiving $80 million from the incoming warrant conversion. They still have $105 million servers revolver. They have over $200 million in undrawn commitments from the Department of Energy Loan Program Office to expand from 2 gigawatt hours to 8 gigawatt hours in Pittsburgh. EOS should also be receiving around 5% deposits on few upcoming orders. And I do expect modest dilution along the way in order to accelerate growth, and I'm okay with that. Basically, the conclusion here is EOS should have enough liquidity to ramp up this business and become a multi-billion-dollar behemoth. So, my expectation is that EOS should be doing somewhere between 20 and 60 gigawatt hours of manufacturing capacity in 2030. Is that reasonable? I think it is. I think it's less than 5% market share based on conservative assumptions, even for the US. And at a $200 per average selling price with 35% gross margins and 25% net income margins, that should equate between 1 and 3 billion in net income. That with the growth they had seen and that expect in the future should warrant somewhere between a 20 and a 50 price to earnings multiple and a $40 to $100 share price. This is all very nice, but the thing is, the key here is execution. So will this company be able to execute in this business plan and get to the 20 to 60 gigawatt hour of production capacity? Will they? We need to arrive at those conclusions. So the main thing here is the team. Who's the team behind EOS Energy? You've got CEO Joe Mastrangelo. You've got Nathan Croker as the CFO. You got Servers, which is a $60 billion private equity firm who owns 33% of EOS. You got Francis Rishi as their Chief Technology Officer, and you got a new Chief Operating Officer that came from Jabil, a $20 billion manufacturing giant, only a couple of weeks ago. Joe Mastrangelo. Joe Mastrangelo is the CEO. I do think there is some key man risk if he leaves, but I think it's very unlikely in my opinion. He's a factory guy. He's not technically a founder, but EOS is his baby. He's been here basically since day one. I see him as very candid. I haven't met him, but I have listened to every interview he gave. I've also reviewed every earnings call they did. I tried to analyze every word that came out of his mouth, and I do see him as a very candid person. My channel checks, reference calls, etc., they all indicate that he's a killer. He's extremely capable. He works his ass off. He brings the GE culture to a startup. He's okay with burning people out because he's the hardest working man in the company. And he does expect a 20% turnover per year. Basically, the bottom 20% performers in the company, they should be replaced every year. That's the GE culture he brings to the company. He used to be the CEO of Gas Power Systems for GE Power, where he managed over 15,000 employees. So this is key here. He has done this before, and he's planning on doing it again in EOS. And he is not a startup founder with crazy dreams of conquering the world and solving cancer. He's a down-to-earth guy. He's an energy guy. He sees things as a cost per energy, and he moved from managing 15,000 people in GE to EOS Energy, where they have 700 employees right now and scaling fast. Nathan Croker is the CFO and current Chief Commercial Officer as well. I believe that Nathan did a lot with what little he had. He had risen to the occasion multiple times in a very short period of time. When the Chief Accounting Officer resigned, he took over that role while the position was filled. When the former CFO resigned, he took on that role as well, and he was both the CFO and the Chief Commercial Officer. So he has risen to the occasion multiple times, and it seems like Nathan and Joe really make a good team. Joe is not the easiest person to work for, but that's because he has a high bar, and it seems like Nathan meets and exceeds this bar. Nathan has been the CFO since 2023, and there has been some painful dilution along the way. But the thing is, deals probably could have been done a little bit better. They could have maybe maximized a little bit better. But at the end of the day, he threaded the needle with the very few tools in the toolbox he had, and he did a job probably 9 out of 10 people would have failed at, including myself. So I have huge respects for Nathan. Cerberus is a key piece in this investment. They're a $60 billion private equity firm. They were founded by Steven Feinberg, which is currently the number 2 guy in the Department of Defense for the current Trump administration. And he's the kind of guy that in his senior thesis, he dismissed books and he formed his own conclusions on the streets of New York, where he interviewed people. It happened to be prostitutes among some, but he's the kind of person that goes to the street and tries to find the truth from a first source. And I do believe that's the due diligence process they went for with EOS Energy. They are expert investors in defense, in infrastructure, and in industrial sectors. They own 33% of EOS, and after sitting on a substantial gain, probably upwards of 500%, in June of this year, they decided to lock up their shares for an additional year and lower the interest rate from 15% to 20% to 7%, showing they're a good business partner and that they have incredible confidence in the company. I believe that as a small shareholder, by investing in EOS, I'm benefiting because I'm getting a highly aligned, capable, synergistic, and value-adding partner in Cerberus. Nick Robinson, which is the guy in the photo, is Cerberus lead on the company. So, this is the comment from David Stroppert, founder of 5P Capital Management, saying, if I had a short list of funds I would allocate money to, they would certainly be in that short list. And a comment from Steven Feinberg, the owner of Cerberus, says, we tried to hide religiously. If anyone in Cerberus has his picture taken in the paper or his apartment, we will do more than fire that person. We will kill him. So people shouldn't expect Cerberus to be yapping all around the world talking about EOS. They're not that kind of firm. They're the kind of firm that put their head down, execute, and let the business speak for itself. Cerberus has incredible confidence in EOS. This is shown in their latest public comments where they said, Cerberus is ecstatic about the incredible progress made since our initial investment. Joe and the team continue to fire on all cylinders, and Cerberus will continue to be all in helping EOS execute. National security imperative could not be more important, and they're going to help EOS build a large global platform. Cerberus views EOS as the First Solar of the battery space. First Solar is the leading American company in solar panels, which is around a $20 billion market cap company, even though that industry is highly, highly dominated by China. And they see EOS as the First Solar of the battery storage space. When they decided to invest in EOS, they mentioned that they see EOS producing upwards of 8 gigawatt hours in Pennsylvania, and that they could see non-lithium technology ultimately become around 30% of the overall energy storage market. If that happens, EOS is going to be simply a monster. I do see EOS dominating the non-lithium space, and if this ultimately happens and non-lithium actually represents 30% of the overall energy market, EOS should have at least a third of that, meaning they should have a 10% of this market. The company would simply be huge. Francis Rishi is our Chief Technology Officer. He's the key guy responsible for the C3 tech, basically developing the technology that stops dendrites from forming in a static aqueous battery. And everybody loves him. From all our channel checks, everybody respects him. Everybody says he knows a lot about his stuff. and he's agreeable, he's easy to work with. Everybody agrees that Francis Rishi is a great asset to have in the company. He is a Stanford graduate, and most of his professional life has been spent in EOS. These are some quotes from former employees basically saying how Francis Rishi, he's fantastic, he's great, and here they're saying how Joe is the captain of the ship, and so forth. Finally, we have John Mehas, which is our Chief Commercial Officer. He recently left Jabil, a $20 billion manufacturing giant, where he served as Senior Vice President of Operations. There, he oversaw over 70,000 employees across 30-plus factories worldwide. So he had an incredibly amazing job. Why did he come to EOS? Well, he came to EOS because he believes in the opportunity to replicate production lines and build a global manufacturing footprint around a transformative American technology. And that is exactly the kind of challenge that he's built for. I'm here to help EOS operationals at scale, drive world-class operations, and take the company to the next level. Whoa, so he's talking about multiple production lines and a global manufacturing footprint. Will there be demand for EOS to set up multiple manufacturing facilities and a global footprint? We don't know. There certainly are risks there, which are, I see basically the two main risks being competition and execution. Execution meaning filling up the backlog, scaling with it, and proving out margins. In the competition space, I see lithium by far as the biggest competitor for EOS. Lithium-ion costs have dropped far beyond anyone's expectations seen in this graph. But the thing is, even with ultra-cheap lithium-ion batteries, I believe there will be a market for a non-flammable, silent, stackable, supply chain secure battery priced competitively on a cost for energy. This is not only a national security issue, it's an enterprise supply chain issue. Every big utility, every big company, every hyperscaler, nobody would want to rely on a single technology, especially if that technology is highly dominant for China. So even a small-digit percentage of this battery market merits a multi-billion-dollar company, in my opinion. Then the risk of a non-lithium competition, as we currently speak, there are basically non-competitors that are at scale right now. No one is producing at scale except EOS. Most competitors use these flow batteries we talked about earlier. With these flow batteries, from a first principle standpoint, I don't see them grabbing much market share. They are too complex, there are too many moving parts. Operations of those batteries are simply a headache and costly. And also they are abandoning their modular cube solution and they're doing like a project-based solution which doesn't scale as nicely as an industrialized manufacturing solution does. However, at this early stage, any project that gets installed that is non-lithium is a win for the whole industry. So I'm definitely rooting for every non-lithium company out there. I hope everyone does great. But the thing is, I don't have much expectations for any of them except EOS Energy. So what comes next after all those risks? I think the market is going to realize that EOS is the best-in-class US battery and the demand that this will signify. There's a huge risk with China's overdependence in the battery industry. They dominate this whole industry. And right now, as a result of this domination, Trump administration is setting up tariffs, which are particularly harsh in the battery space because they want to bring that manufacturing to the country. With current tariffs, EOS is a cost leader. Chinese batteries are around $250 or upwards per kilowatt hour, where EOS is, and they do not benefit from tax benefits as EOS does. So basically, EOS is a cost leader right now, or it should be fairly soon. The domestic manufacturing for key technologies is a national security concern. You've got white papers published by the government saying new sources of energy to power it all. The infrastructure must also not be built with any adversarial technology that could undermine US AI dominance. And OpenAI, this is OpenAI, is saying authoritarian competitors are already exporting the AI system abroad. They're embedding surveillance models and closed networks into the infrastructure of emerging economies. If left unchecked, these exports will lock countries into autocratic tech stacks and reinforce dependency and restrict freedoms. What they're saying is that we need to accelerate US exports of supporting energy technologies. Among those supporting energy technologies, long-duration battery storage is particularly mentioned. So let's hear the CEO of NextEra, the biggest gas, nuclear, and battery storage operator in the world, talk about this domestic manufacturing issue.
NextEra is fully behind moving away from China. I mean, if you look at our supply chain today, we buy all our batteries here in the U.S. We source our gas turbines in the U.S. from GE out of South Carolina. 90% of our wind turbines are made in Florida. You know, we have really pivoted to a domestic supply chain. But let's make this at a component level where we're looking at the major pieces of equipment and make it and design it in a way that can actually be complied with instead of a gotcha where you lose all your credits. Because I mean, there's no American company in any industry that can comply with these provisions.
Well, that sounds like a big hurdle, and one of the big areas that you didn't really even touch on there is the battery technology, which is a field that you're getting into. When are we going to see battery technology really make a big difference and start to show strength on the grid?
Yeah, great question, man. I mean, we're the world's leader in battery technology. It already is. I mean, so if you think about capacity resources, right, there's energy, and then there's capacity, which is, you know, having the energy during the hours of the day that you need it. Battery technology's come a long way, and so when you really look at when customers need power for reliability purposes, it's typically during those evening hours from 5 to 9 at night. But we have 4-hour batteries that can accommodate that can make renewables 85% firm. And batteries are much cheaper than gas-fired peakers, and actually are displacing gas-fired peakers in most parts of the country because of those phenomena we talked about earlier.
There's a lot of Chinese ties to this industry as well, the technology.
Yeah, and what's great is we've been able to now source all of our batteries from a company right here in the United States, being able to decouple almost entirely from buying from Asian suppliers.
Is that going to be your demand and your peers' demand, or is that going to be a constraining factor in terms of demand?
Well, you know, it's something NextEra's been able to do. I think you'll see the rest of the industry continue to pivot to more domestic purchasing. And what's happening, what's great about this is that as we're moving the supply chain here to the U.S., we have a 45X manufacturing credit. We're creating a ton of jobs right here in the United States. We're having a huge impact on rural economies, on state economies, through property taxes, through sales tax revenue. I mean, it's a multi-trillion-dollar industry today.
It's incredibly encouraging to hear the CEO of the biggest utility in the world talking about how they've been able to source all their batteries from the United States. We already know that NextEra has a $1 billion 4 gigawatt-hour letter of intent with Eos Energy. I do expect an order to materialize fairly soon. It shouldn't be surprised anyone after all this that battery energy storage is highly favored by the current US legislation. So after the big beautiful bill was finalized, battery energy storage benefits the most from these credits alongside fossil fuels, nuclear, geothermal, hydropower, and critical minerals processing. Among all those, battery storage is treated exactly the same. The thing is, in order to benefit from all these things, you need to comply with the American dominance narrative. That means that the domestic content must hit at least 55% in 2026 and increasing 5% each year, which is very hard for the current offerings that are in the market. All these credits, they basically, what they mean for EOS is that EOS gets a $45 per kilowatt hour for every kilowatt hour they manufacture. This is basically a 20% on top of their average selling price. And their customers, they get the investment tax credit, which is around 30% and can have 10% for domestic content, which EOS qualifies for, and they can have another 10% for energy communities, low-income areas. So someone who buys batteries from EOS can have around 40 to 50% tax credits on the purchase of EOS systems. That is incredibly beneficial. But not everybody benefits from this, only the ones who comply with this domestic content. And for this investment tax credit, you need to comply with domestic content of the whole system, where solar panels, which come from China, might make you be below this threshold. But with the excess domestic content that you have with EOS Energy, which is over 90%, you might be able to do a system where you put Chinese solar panels and a EOS battery and still be within this domestic content threshold that most other technologies cannot do. So the risk of filling up the backlog and scaling with it. EOS needs to deliver 600 megawatt hours in Q3 and Q4 of 2025, and at least 2 gigawatt hours in 2026. These 2 gigawatt hours for 2026, they need to turn into firm orders. Those orders are not there yet. When I look at the backlog, I don't know where those 2 gigawatt hours are going to come from. The thing is, EOS has a sales milestone on October 31st, 2025. This has been pushed 3 times, and I do expect them to hit them this time, hopefully. The thing is, this is a make or break issue for EOS. If EOS doesn't materialize these 2 gigawatt hour orders for 2026, you're basically saying they're going to go bankrupt. You're basically, because they would have overbuilt for a demand that's not there. The thing is, I have strong conviction they will get there because servers extended their lockup for an extra year on 2025. I see no reason they would have done that if they didn't have a clear line of sight for, at the very least, 2 gigawatt hours of orders materializing in 2026. So is it overly optimistic to expect 2 gigawatt hours of orders for 2026? I don't think so. I mean, servers double down, and you're seeing that batteries are the cheapest, fastest, and easiest energy system right there, right while we're talking about a demand energy tsunami and a supply constraint for energy systems. I do see a very bright future for this company. So EOS has already been talking about future data center deals and them being in the direct and indirect form. So the IEP data center that we talked about, the 2 gigawatt hour IEP data center, that's a clear example of an indirect project. They're partnering with the developer, which is IEP, which they then sell the compute power to a hyperscaler or whoever wants to have that compute power. But they're also saying they're partnering with hyperscalers to directly develop a battery system that fills their needs. I believe that EOS will soon have a deal in place where they have a direct relationship with a hyperscaler. Why? Because there's a national security risk. China's new weapon in US trade talks, as Bloomberg cited a couple days ago, are batteries. Why are they batteries? Because this AI race is constrained by energy demand in the US. In China, the AI race is constrained by chips. The US is saying, hey, I'm not exporting you the best chips. In the US, the constraint is energy. And it could be very possible that China starts saying, hey, I'm going to stop exporting energy equipment so that the race and the AI race is more even. So there is a very large national security risk, even for hyperscalers, because it's not just the US competing against China. It's the American companies competing against the US, against the Chinese companies. It's OpenAI and Amazon and Google competing against Huawei and whatever else. The thing is, these hyperscalers are not blind to this problem, and in early 2024, they already issued a request for information overview where they wanted to develop new business models and aggregate their demand to accelerate the development of these technologies, among them long-duration energy storage. The requisites for this is that the technology maturity needs to be over 6, which EOS does. They need to have traceability. They need to know where the supply chain is coming from. The project needs to be ideally over 50 megawatts and over 8 hours of duration, so at least 500 megawatt hour orders. And they need to see a path for them to becoming cost competitive with existing power sources before 2040, and that a path to scale a technology to over 100 gigawatts of total deployments by 2040. 100 gigawatts of deployments before 2040. That is a lot. That is way, way higher than my estimation. This needs to come from a usage of materials, goods, and components that are manufactured in the United States, and that the commercial operation dates needs to be 2030 or earlier. So companies that do not have commercial scale projects right now, as EOS does, are going to take a fairly amount of time. And EOS does look like one of the very few companies that could meet all these criteria. Google has already shown support for multiple long-duration energy projects. Here they quoted, Google will support multiple long-duration pilot projects in Arizona with technology developers identified by SRP. Here, the head of energy market innovation from Google is talking about the benefits from 10-hour demand responses from batteries. And I'm missing here the latest ESS order from Google that they got, where they're basically doing, I think, a 15 megawatt hour order, which for EOS standards is tiny. I mean, it's great to see another company get an order, but for EOS it's tiny. But it shows that Google is on top of this long duration energy storage and they do want to invest in this technology. Microsoft is saying, hey, we need renewables, they are vital. We need firm dispatchable capacity, for example, batteries paired with renewables at longer durations. They're saying small modular reactors and fusion each face their own regulatory pathways, and even after approval, scaling will take time. So we will need a mix of solutions right now, and nuclear is not fast enough. We need commercialization and scale of new power distribution technology so capacity is built dense, efficient, and serviceable. And we need to de-risk procurement. The development of lithium-ion technology took 7 decades. We need to take these advancements in battery technology and cut them at a fraction of that. OpenAI is saying that we need to build out this infrastructure. The US can transition from our current dependence on offshore manufacturing into an onshore manufacturing giant. That strategy begins with onshoring our energy needs and a true US reindustrialization. This is OpenAI talking, the leading AI company in the world. Among these energy technologies, they quote long-duration energy storage. And they are worried how authoritarians, basically China, are treating this technology, and that we need to accelerate US exports of these technologies to other countries so that they don't fall into the hands of these authoritarian governments. We talked about earlier how OpenAI plans on demanding more energy in 2033 that whole India demands today. So it's an important reference to keep in mind. EOS Energy, I don't know how many people have this in the center of their mind, but EOS will shortly have firm orders to supply both the data center industry and the defense sector. That is huge. That are two of the main fastest growing sectors in the US right now. They have the data center order from IAP when they finalize. It's not finalized yet. And they have a multi-$100 million order for the Camp Pendleton. And they also have a naval base on San Diego order, and they're all coming from repeat customers. These are customers that have already tried EOS product, and they say, hey, I like it and I want more of it. It's important to keep in mind that as the technology develops, the capital stack of these projects varies a lot. Basically, when you're in research, it's full of grants. When you're in prototype, it's 20% grants and 75% equity. That's where EOS was a couple of years ago. When you're in the pilot phase, it's 50% equity and 50% grants. When you're in first-of-a-kind project, debt starts to come in the way. So you get a third of debt, a third of equity, and a third of grants. That is basically what we're seeing in the multi-$100 million order in the US Camp Pendleton project. And then when you get to repeat projects, so basically already proven out in the field, it's financed with 80% debt and 20% equity. This allows for a way faster deployment of the technology, which I believe EOS will be there fairly soon, if not already now. What the customers want is a modular, software-orchestrated solution capable of coordinated or fragmented operations with ultra-fast response. That is exactly what EOS brings with their operating system under C3. The response time is 5 milliseconds. It can be collocated with energy demand because there's no fire risk. And it's the only solution that can be stacked vertically, resulting in a best-in-class energy density. Finally, they allow between a 2 to a 20-hour range of discharge duration. What I keep thinking on and on and on is that a single large data center deal would reset how the market underwrites EOS terminal value. I mean, with EOS, you have a team that has significantly over-executed, you have a product that fits perfectly, you have an experienced private equity firm as owners of the business, doubling down on their investment even after a 5% gain. You have at least one world-class customer who is one of the top 7 biggest companies in the world if you get the hyperscaler order. And this, if you get a hyperscaler order, I would imagine it's a multi-gigawatt hour order. If you get a multi-gigawatt hour order, all of a sudden, Tesla's current 40 gigawatt hour production, achieving that in 5 years, so achieving where Tesla is today in 5 years, doesn't seem crazy at all. And if you do that, you warrant around a 50 billion market cap company at least. So it's a complete shift if EOS gets a data center deal, which I believe should be done fairly soon, given all this demand tsunami we're seeing. With energy storage, we're right in the middle of the S-curve. You're in the steepest part of the S-curve, and people haven't woken up yet on how this market is going to grow very, very soon. Boots on the ground, basically. As I said, I went to the RE Plus conference in Las Vegas. This is a company photo that was taken by EOS Energy. It's awesome to be in it. I didn't expect it, but I like to see it. And we also went to, I also went to Pittsburgh's manufacturing facilities in early May, late April, something like that. And there I met with everyone that would speak with me, basically from former employees to university professors to the Energy Innovation Center and whatever. Everybody had the same thing to say: hey, EOS is great, they work their ass off, and they're scaling incredibly fast. Be prepared for it. I met with a former employee that said, hey, I worked there for 3 years, I only took 3 days off, and I basically said, hey, I need a lifestyle change. I quit it and I bought stock. That was a former employee's quotes. I mean, that's not hard evidence, that's anecdotal evidence, but in my mind, that is gold. To finalize, I have no special insight regarding what stage of this AI bubble we're at today and this infrastructure build-out. I do see all the announcements of NVIDIA investing in OpenAI, and then OpenAI investing in Nebius, and then Nebius are investing in CoreWeave, and everything intertwined one with another. I do not know where this ends. I don't know in what stage we're at, but I do think that EOS should fare well even if AI CapEx spend is significantly reduced. I mean, the energy grid needs modernization and lower cost alternatives regardless of AI spend. I want AI spend to increase and for that to translate into EOS orders, but even if that doesn't materialize, I do see a lot of product market fit and demand for EOS solution anyway. This is the last part of the presentation. EOS Energy is a high growth company, for sure. Everybody knows it. But it's a completely different kind of risk profile than many other high growth companies. EOS is not trying to solve superintelligence. EOS is not trying to solve nuclear power and put it in your phone and that not being dangerous. EOS isn't trying to cure cancer. EOS is just trying to scale a manufacturing line. They just need to copy-paste what's already done. This video helps illustrate this. One cube after the hour and the other, one after the other. Copy, paste. That's all EOS needs to do. They need to put thousands and thousands of those tabs and sell it to customers. Will there be willing customers? I think so. These are the disclaimers. Thank you for your time. I really enjoyed this. Happy to interact with anyone who has questions, comments, feedback, and anything.